Good afternoon, everybody. Welcome to SAX with Tax, our Q1 webinar presentation. I'm going to start off with some housekeeping items. Our firm provides the information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting advice, investment advice, or any professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. For those of you looking for CPEs, just wanted to let you know that this webinar is also being recorded and you will receive an email with the recording along with the slides. If you have any questions, please type them into the chat box. If you're not able to get to them, we will probably respond to you later with an email or a call. Participants who are looking for CPEs must stay connected to the GoToWebinar for entire duration of this presentation. We expect this presentation to run an hour, which would grant you about 1 hour of tax CPE. Participants must answer 75% of the polling question. If you have difficulty answering the polling question, that is, if your answer does not register, hit the escape key to minimize your screen and try again. If this does not work, please type that into the chat box. The participant course evaluation in the handout section of the control panel should be downloaded, completed, and emailed to jtoshi@saxllp.com to receive your CPE credit. With that, it takes me great pleasure to announce our panelists for today. Three of my peers who all got promoted to tax partners at SAX effective January 1, 2022. First is Craig. Craig specializes in network tax compliance and advisory, as well as gift and estate compliance and planning. He also serves as a co-leader of the firm's private client practice. He has working knowledge of hedge funds, private equity, real estate, with individual clients exceeding approximately $2 billion in net worth. Frank Centrella is a leader of the firm's tax controversy and dispute resolution practice. Frank is responsible for all controversy matters at the firm, including examination from federal and state agencies, offers, compromises, and compliance with FBAR matters. And finally, Helena currently oversees the firm's private foundation practice. She provides clients with a wealth of experience in tax strategies, charitable giving, legacy planning, and transaction support. So to go over the agenda, I'm going to briefly discuss Schedule K2s and K3s. These are new for 2021 filings. Craig is going to discuss 2021 tax compliance process. Then Frank is going to go over common IRS audit triggers. And finally, Helena is going to talk about the 2020 annual limits and planning. I'm going to start off with our first polling question. Have you attended a tax with SAX update before? If you are looking for CPEs, please answer the question. We have less than 10% of the vote-ins as of now. I am going to give it about 3 or 4 seconds more, 82% of the votes in. I am going to close the poll in 3, 2, 1. So 75% of you have attended tax with SAX updates before. So I just wanted to start off with giving you a brief overview of Schedule K2s and K3s. So as I said before, that these forms are new for 2021. Schedule K2 is an extension of Schedule K and is used to report items which are of international relevance. So IRS is trying to have us fill in these forms so that they get a more detailed and accurate information from all the partnerships and S Corps. And Schedule K3 is an extension of your Schedule K1, which is generally used to report items to your members or your shareholders. The key thing here is even if a partnership or a S Corp has no foreign source income, no assets that are generating foreign source income, or have no foreign tax paid, you still may be required to fill in these forms K2s and K3s. So let me give you an example. So I am a member in a partnership, and Frank is the other 50% member. It's a real estate partnership. It doesn't have any items of foreign source income. But I, as an individual, have foreign tax credits from other sources. Let's say I have a rental property overseas, or I have a brokerage 1099, which gives me foreign tax credit in excess of $300, which is the minimum requirement to file a Form 1116. The partnership, the rental partnership in which Frank and I are partners, will need to file Form K2s and K3s. Still, it doesn't have any foreign source income because it's all rental income from US sources. They have no foreign assets, but because the partners in this partnership have some foreign attributes, Form K2 and K3 will require to be filed. Next slide, please. So the issue with these forms is right now, IRS has not qualified these forms to be filed electronically. The time frame which the IRS has given us is partnerships. The forms will be ready approximately around March 20th. And for S Corps, these forms will be ready mid-June of 2022. So the alternative there is that, the tax program or the software we use creates PDF of these forms, and then we can attach the forms K2s and K3s as PDFs and then file it electronically. So the anticipated tax program software date, which, where the software will be able to create the PDF on its own electronically, is February 21st. So there are some delays in, processing the returns and getting these out. We just wanted to give everybody a heads up that these are the time frames, what we are looking at when, these forms will be ready. Just to give you a sample of what is entailed in these forms are voluminous. Just the Schedule K2 for S Corporation is 14 pages long. It has a lot of details on it. The K3, which is going to go to the shareholder, is 15 pages long. And then the 1065 K2s and K3s are even longer, with 19 and 20 pages long. So we feel that, some part of the schedules will be required to fill out for all the entities, but not all. Just also wanted to go over some of the penalties that could be applied by the IRS in certain situations where these forms are not completed or not completed accurately. So the first of the penalties, either on the partnership side or on the S Corp side, is failure to file or show information on a return. That could be $210 per partner per month for a maximum of 12 months. So it could add up if you have significant number of members or shareholders. And another penalty that could be levied under 6721 or 6722 is the failure to file correct information return or failure to furnish correct payee statement. That is $270 per failure. With that, I'm going to pass it on to Craig.
Thank you, Shivani. Appreciate it. Hello all, good afternoon, good morning to some. As Shivani mentioned, my name is Craig Casano. I'm a partner here in SAX's tax department, focusing primarily in high net worth individual tax. And today I'm going to speak a little bit about 2021 tax compliance and some things to keep in mind as it relates to that, as well as beyond 2021 into 2022 and even further, and some potential planning opportunities and strategies as we start to look downfield a little bit. So just to jump into 2021 tax compliance, we're currently in the process of gathering tax documents. Our clients and obviously taxpayers, Forms W-2s, 1099s are being released as we speak, and they're coming in rapidly. Folks may be getting them via mail, some may be getting via email or electronically on various websites. Just be mindful of that, and we ask that folks continue to send in their tax documents timely. Moving on, as it relates to medical expenses, for purposes of deducting medical expenses, you can take these deductions to the extent they exceed 7.5% of AGI or adjusted gross income. So one thing to keep in mind as you're compiling records or even going through checkbooks or online statements or things of that nature, as it relates to investment of your own time as you compile this for your tax advisors. Just have a conversation prior to doing so and investing any time, because there may be certain situations where depending on the level of your income, it might not be worth spending the time to compile that data. So basically your expenses would have to exceed 7.5% of your adjusted gross income. Just to put it simply, if your income for the year is $100,000, if your medical expenses are not exceeding $7,500, it wouldn't be worth looking into it. Certain states, for example, New Jersey, the percentage is smaller, so it might be worth in that case to take a peek at them. But again, definitely important to have a conversation with advisors to determine whether or not it makes sense to spend the time. Charitable contributions, a lot of folks give charity throughout the year, whether it's in the form of cash or securities, or even in some cases, some may give artwork or other such items. With that, what we're really looking for, or what you should keep for your records, and hopefully that charitable organizations are sending them, are acknowledgement letters, pretty much acknowledging the fact that the contribution was made and when, and the fact that they are what's known as a 501c3 charitable organization, which would otherwise allow you to take that deduction on your tax return. So definitely keep an eye out for those, especially for contributions that were high in magnitude. Coupled with that, there could be situations where maybe you attended an event, a dinner or what have you, an auction, and there's times where maybe you might have written a check for $1,000 or so, let's say. Of that $1,000, there could be a piece of that that's non-deductible for tax purposes, to the extent you receive some kind of benefit for it, whether it was attending the event and having a dinner, or if it was an auction. There could have been certain situations where a part of the charitable gift, if you will, is non-deductible, as there could have been value that came along with it. For certain non-cash contributions, whether it's artwork or jewelry or something of that nature, if it's over a certain amount, $5,000, there would have to be a qualified appraisal for that before a deduction is able to be taken on the return. So keeping in mind for that, deductions could be limited to $5,000 in the event appraisals were not received for the year. So keeping that in mind for 21, as well as looking forward for future years as well, to the extent you're looking to make big charitable contributions. Advanced child credit letters, these the IRS are currently sending these out. At the bottom, I believe it says IRS 6419. During the second portion of 2021, the IRS was sending advanced child credit amounts to folks, either direct deposited into their accounts or via refund, depending on how prior year tax returns were filed and what information was put on the return with regards to how those were going to be sent. Also for 21, to the extent you have self-employment income, whether from a Schedule C business or otherwise, there could be potential retirement plans that could be set up to generate additional tax savings. There's SEP plans that could be set up of $58,000 max contributions, depending on the income level. Could be certain cash balance plans and pension plans that could be set up. In that case, it would certainly be best to speak both to your tax advisors as well as SAX wealth advisors to determine what might be right for you. Next slide, please. So thinking a little bit about 2022 and beyond, and when I say beyond, and more specifically for now, being that here's where we are now in tax law. Things could change, but based on where we currently sit, these are some things to keep in mind as we start to kind of look forward to the horizon. What I'm going to lead off with is change in tax residency. What we saw a lot of, specifically during the pandemic, is folks really starting to reevaluate their lives with regards to where they're physically going to remain present, more specifically from a tax residency perspective. And just kind of just thinking about a very high level, whether someone is traditionally was living in California or New Jersey or New York and continue to have residences there, that's where this discussion that I'm about to have is relevant. So taking New Jersey, for example, A lot of our clients, what we're seeing is specifically as it relates to the pandemic and whether they're looking to retire or even just relocate. Whereas now we're in a different world where folks are able to work from home and rearrange their lives. And if we can couple tax efficiencies with that, that's really what we're trying to target. But two of the things to keep in mind, if this is at the forefront of your mind, is the states, New Jersey, California, New York, they're going to look at taxpayers from two different lenses. And one is domicile, and then the second would be statutory residency. And when I speak about domicile, what I mean there is if a taxpayer is going to say, okay, for a certain tax year, I'm no longer a tax resident for New Jersey purposes. I'm now in Florida or Nevada or Texas, or pick a state that doesn't have income tax. Well, obviously New Jersey, New York, and California, they're kind of, they're on to these plays. They've seen them for many years, and they know exactly what folks are trying to do. So what they're going to do is they're going to test you in two ways. Like I said, domicile and then statutory residency. Domicile, really taking a look at where a taxpayer's roots are. Where do you call home? Where do you hang your hat? And there's certain tests that go into that. And now if a taxpayer passes that test and the states say, okay, you broke what's known as your domicile. We believe that you've now uprooted yourself, took yourself out of this state. Now, if you put yourself in Florida or one of these other, non-income tax states, what they're now going to come after and look at is day count. And that's more of a bright line test. And that's when we speak about statutory residency, they're looking at, do you surpass a certain amount of days in those states, whether it's New Jersey or New York, for example. Were you in those states for greater than 183 days? If so, whether or not you broke domicile, all bets are off. You're being pulled right back into that state that you claim you're no longer in, and you're going to be fully taxed on all of your income as a full year resident for that state. So keeping that in mind, as you're speaking with your tax advisors, if that's at the forefront, or if that's something that you're thinking about, definitely keep in mind domicile and statutory residency, and we'll be happy to have conversations with folks to kind of lay out what's required for both of those. Moving down the list a little bit, just speaking with mortgage interest deduction and limitation, as well as leveraging real estate for investing. Those two are kind of interrelated. And just speaking with mortgage interest for a second, back in 2017 with the Tax Cuts and Jobs Act, historically prior to TCJA, the limitation for mortgage purposes for which you were able to deduct mortgage interest was up to 1.1 million of acquisition indebtedness. With Tax Cuts and Jobs Act, the IRS brought that limit down to 750,000 for loans that were taken out post December 15th of 2017. So just keeping in mind for yourself, if you're looking to take a mortgage now, there could be a situation where your mortgage might exceed that $750,000 principal amount. In that case, your mortgage interest would have to be limited. There could be instances where larger mortgages are out there. What I would say, and kind of moving down the list there with the leveraging real estate for investing, what I mean by that is there's certain situations where you could pay down some of that principal, pull it back out, and then use the proceeds for investing in taxable income generating assets, whatever those may be, whether it's an interest in a partnership or even putting it into a brokerage account that's going to generate taxable income. In those situations, the interest on that would be deductible as investment interest expense against investment income that you might have, whether it's interest or dividends or what have you. So something to keep in mind there. Another opportunity that could be out there, which I think is certainly important to chat with your SAX Wealth Advisor on, is just overall, portfolio investments and strategies, tax exempts versus taxable. Obviously in bull markets, when gains are through the roof, it's part of this could be moot. But as the market becomes volatile and risk tolerance becomes low, and when you start thinking about taxation, specifically if you're in states that have very high income tax rates, whether it's California, New Jersey, New York, obviously always naming those top three, when you couple those with your federal tax rate, as well as the 3.8% net investment income tax rate, there could be instances where overall tax could be 50 cents on the dollar, if not more. So overall, when you think about that, when you weigh in risk and kind of just makeup of income that's coming out through some investments, could be better served to pull out some, not all, some of the investments and put them into tax exempts, which would be a little bit less risk, obviously, usually less return, but when you factor in kind of after tax return, you could end up in some cases in a better situation. Next slide, please. So the final few items I wanted to discuss with regards to 2022 planning and beyond, with installment sales, there could be certain situations where folks may be looking to sell part of a business or some other asset. Installment sales allow you to split that over certain years, depending on the the payout schedule for the payment on those. And in that case, you would be able to defer the tax over that time. And in certain instances, there could be opportunities to reduce your overall tax rate, as well as eliminate or mitigate potentially the 3.8% net investment income tax. To the extent that it's a sale of an asset that's not an active business, if you will. So definitely certain things to keep in mind. Qualified small business investing, or Section 1202 of the Internal Revenue Code. This is a section which taxpayers are able to invest in certain small businesses. The main thing to keep in mind is at the time of investment, the business has to be under $50 million of assets. So anything over and above that, wouldn't be considered small. But keeping in mind, most folks may think that 50 million is not small. I know I don't, but under the Internal Revenue Code, 50 million asset is still considered small. In that case, assuming certain boxes are checked down the road, one of the main ones being that you remain in the investment for 5 years or greater, there could be the potential to not recognize or not have to pay tax on those gains down the road. So something to keep in mind as you may or may not be investing in certain things, whether it's through PE or even separately. Charitable contributions, obviously the big one. I touched on that briefly earlier, but just to kind of continue with that point, and Frank will discuss a little bit more on that later on. But charitable contributions of appreciated securities, to think about giving those directly to charitable organizations, or even in some cases donor advised funds that may be set up. There could be situations where looking to give appreciated securities to private foundations. In this case, there's certain instances where, from an appreciated security perspective, the amount of deductibility in a given year depends on the overall percentage of a taxpayer's adjusted gross income, or AGI. For example, with private foundations, the amount that's deductible in a given year, to the extent you give securities, is limited to 20% of AGI. So in that case, if income is 100,000 for the year, or adjusted gross income is 100,000 for the year, 20% of that would be 20,000. In that given year, if you give appreciated securities of, say, 30,000, it would be deductible up to 20, and then the remaining 10 would carry forward for 5 years. So the last item I wanted to chat about is grouping of activities and active versus passive. So just in speaking very, very high level, taxpayers or folks may be invested in certain vehicles that generate for them what's known as passive income or passive losses. And those rules are governed under Internal Revenue Code Section 469, which basically says that if a taxpayer participates in certain activities for a certain amount of hours, in those cases, or under a certain amount of hours, I should say, in those cases, those investments are known to the taxpayers as passive in nature. So in that case, if there's losses being generated from those activities, they would not be able to deduct those passive losses against other income on their return, whether it's wages or Schedule C business income, interest, dividends, things of that nature. to the extent they're generating passive income, and we call those in the industry pigs, or passive income generators, which are actually at times difficult to generate. Until passive income is generated, those passive losses become suspended. So at times, what could be beneficial is there could be certain situations where the taxpayer may have various investments that may or may not be related to one another, or connected in some way, that may allow for what's known as a grouping election, or a grouping of these activities into one, which would then otherwise put the activities in total as if they're now one activity in an aggregate, and then now allow these losses that otherwise would have been passive to become active losses that now you can take against other forms of income on your return. So something to keep in mind, especially, as you're speaking with your folks here at SAX or otherwise, there could be certain instances where losses that would otherwise be suspended, you may be able to take advantage and do some tax sheltering in a given year. So I will turn it back over to Shivani with that, and thank you everyone for your time. I appreciate it.
Thank you, Craig. Over to polling question number 2. Who on this panel was promoted to partner? If you are looking for CPs, please try to get your answers in as soon as possible. I have about 78% of the votes in. I'm going to close the polls in 3, 2, 1. All 3 of them are actually promoted to a tax partner. Over to you, Frank.
Okay, Shivani, thank you very much. Thank you very much, Craig, for your time in your interesting presentation. I would like to go through now an item which I'm sure everyone's interested in. What is more likely to make your return being looked at by the IRS? The first thing I would like to do, however, is to try to tell you where the IRS is at right now. And all of these reports and information came out very recently. The Taxpayer Advocate Service publishes statistics at the end of every year and testifies before Congress as to where the IRS stands. So as you could see by the list before, I'm sure this is no surprise to anyone on this call because of everything that's happened with COVID. The IRS has millions and millions of items to get through in their backlog. What the IRS has done at this time is they have designated specific people to deal with this backlog only, and they're slowly getting through this process. But it will take quite a bit of time to get through this, and in some cases they're saying it could take 12 months to clear up all of this backlog. And that's not before they even address the 2021 tax season, which we're in the middle of right now. So if you could go to the next slide, please. Recently, the IRS, in anticipation of having issues for the 2021-2022 tax season, they suspended all collection letters that people have been receiving. Many people have received these because the IRS has not processed the return that they actually filed in time, and they realized that computer programs weren't catching up to what's actually happening. So the IRS has temporarily suspended this notices. There's talk in Congress of having them suspend additional items. I think we just have to pay attention to the media as we see it from time to time. Also, obviously, I mentioned COVID-19. There's a lot of programs that came about, including advanced child care credits. There's been other programs for businesses, including PPP and certain advanced payroll tax credits. all of these additional items, while good for the taxpayer and the businesses, have impacted this backlog with the IRS tremendously and has slowed down the process. So that goes with the next bullet, where the Taxpayer Advocate Service said that this was their worst year ever for the IRS. Not so much because they're being mean, but because they're so overly inundated with work and working remotely that it can't answer questions, respond to notices, and that's what we're seeing with the IRS currently right now. And the ironic thing in all that is the IRS staffing levels over the last 10, 12 years have decreased by 17%. And this is further exacerbating the problem that we're all experiencing. And finally, just to give you a background and a thought process of how many returns the IRS processes on a year, they processed over 263 million tax returns. Now, obviously, that includes individual returns, but as well as businesses and other types of tax returns. So if you're wondering why it takes the IRS so long, you can imagine how long it must take to look through each one of these returns. Okay, next slide, please. Currently, there's about 527,000 returns under exam. Obviously, this number changes from day to day. The amount of examinations are actually down from the prior year, ironically, and once again, mostly due to COVID and the IRS working remotely. The IRS did close a lot of exams during the prior year. So if you look at that math right around there, there's usually about 1 million or so returns that are under examination at any one time. One stat, which I'm sure is going to get people a little crazy around here, is if you've been audited, and most people on this call have income between 50,000 and 10 million, the IRS could take 385 days to close the case from the time you receive your first notice until you finally pay this and the exam is closed and you can go back to living a normal life. There are a lot of interesting stats on this, which I don't want to quote right now. The one thing I thought fascinating is people have received an exam notice, 22% don't even respond to it. That is compared to the fact that when you're examined, only 11% of those examinations result in no change. And with that being said, your chances are generally being audited, if you went through this math, are less than 1%. But the rest of my slides I'm going through are going to explain to you what's going to increase and or decrease that likelihood of being reviewed by the IRS. And okay, thank you. So right now, I would like to go through some of the major reasons why returns are looked at or require IRS scrutiny. The most obvious one are typographical errors and calculations in a return. That could be something as simple as when a taxpayer gets married and they change their last name with the Social Security Administration and use the maiden name on the return they file, or vice versa. That can generate an audit. Hopefully your computer does the calculations right, so that shouldn't be there, but there can also be errors in many areas of the return where the IRS will ask questions. A very common area for the IRS to ask questions about is when you get 1099s, either from your brokerage house, from other businesses, even your bank. Sometimes taxpayers don't always report every single one or are not consistent in that reporting. And that invariably will generate a notice. The IRS has internal systems. It's part of their computer programs to review these returns. It'll automatically generate notices. And if those notices and the differences are large enough, it will result in an examination because the IRS will want to know why and what the taxpayer is doing. So I thought another interesting stat for you is, what are your chances of really being audited? Well, if your AGI is 200 or less, 1%. If your AGI is 1 million, 4.6%. And for those of us who are lucky to have $10 million of AGI, you have about a 1 in 5 chance of being audited. That $10 million figure you should be mindful for. A lot of times that audit number is generated because businesses are being sold or people had large capital gains from positions they've held in a long time. So obviously it's worth the IRS's time and effort to invest in those calculations because they can usually find tax dollars that benefit them. Next slide, please. Another heavy area right now is filing Schedule Cs for sole proprietorships. Most of our businesses that we file usually file in an entity form, whether that's a partnership or a corporate form. But more basic structures involve the Schedule C for sole proprietorship because they tend to be a little bit easier to prepare. However, they do increase your the IRS scrutinizing your returns. So even a small Schedule C with 25,000 receipts can increase your audit rate 0.9%. And if you have a Schedule C with more than 200,000 receipts, your audit rate increases from 2.2% versus a return that does not. Keep in mind, a lot of the reason why the IRS looks at this returns is because there's more issues for them to find. There's more questions. Sometimes you're stuck with a Schedule C format because of regulatory or other reasons, but often we would advise our clients to try to find another form of doing business rather than Schedule C, because it does increase their risk of audit. Another interesting that's related to a Schedule C, people love to deduct their entire use of their car, insurance, gasoline, lease payments. If you deduct 100% of it, you will be audited. It is one of the easiest things for the IRS to find out and discover and disallow. Bearing in mind that if you commute back and forth to work, or you commute to where you're doing your work on the side, that is not deductible. That's still commuting. So invariably, you have to have some degree of non-deductible use of your car. Next, please. Okay, there are some other items which have generated audits in our office and in general. A lot of people like to use the business use of your home as a deduction. While that may apply to certain Schedule Cs, the allowance for such a deduction is often very limited, and there are specific rules that allow the deduction and a specific form you have to fill out. So the IRS's internal systems automatically generate a red flag to look at that return to see if it's worthwhile for them to go in. So that's obviously something that they would like to look at. Travel and meals expense, a lot of this has to do with more historical review of taxpayers. In the past, people have liked to put some more questionable expenses through these figures because they could be so voluminous and so many of them, and some of the meals can be small, and they like to deduct expenses that are kind of on the margins. The IRS always feels that they can find something in these expenses, so invariably if they see high travel or high meals expense, they're going to question it simply because they think some might be personal. Doesn't mean anything's wrong with it, but their stats will make them question what's going on. Two big areas, one that is fairly recent and one that's up and coming, I do want to spend a minute or two on. The IRS instituted a program probably about 15 years ago with Switzerland especially, where they started heavily scrutinizing non-US bank and security accounts. And they determined that not only was there a lot of income tax not being reported on an annual basis, but a lot of assets there were being hidden overseas. So the IRS has specific agents and specific departments dedicated solely to look at this stuff. And what's interesting about that is the IRS is going from country to country to try to find US citizens with accounts overseas and requesting their social security numbers. So it doesn't matter whether it's Singapore, it doesn't matter whether it's Australia, all these countries are being pressured by the IRS to provide this information for US citizens. The ironic side effect of that, and I don't know if anyone on this call has experienced, is many US citizens have great deal of difficulty of opening accounts with non-US banks. So it's just something to be mindful of. The other up and coming item is cryptocurrency. I know everyone loves to talk about this topic as new and exciting, but the reality is the IRS sees this as billions and billions of lost revenue. In the recent bill that failed in Congress, there was going to be resources allocated solely to the review and audit of this figure. So if you do participate in cryptocurrencies, expect that the IRS is going to be looking at your return on a much more in-depth basis on a go-forward basis. So it is coming. Just want to make sure you comply with everything. The IRS will also be setting up standards where the different marketplaces will have to report these transactions. Of course, that failed when it was proposed in Congress, but it will be coming one day. So it is something to expect to come. Hobby losses is a tax term. What some people do is they have small Schedule Cs where they have some or little revenue, but they have a lot of expenses. The IRS likes to audit these items if you generate losses on a consistent basis. They feel that it's really not entered in for a business purpose, but more kind of fun. And if you make money with it, great. So it almost will generate an audit. It's very hard to disprove. Certain business types also create this type of thing. My famous one that I've been involved with several times is people who have horse farms run into this problem where the IRS will presume it's a hobby. Obviously, that's a very fact-sensitive item. So if anyone ever has questions, they can always reach out to me to talk about that further. Another item that the IRS loves to look at is business tax credits. While they'll incentivize businesses to take these credits, that doesn't mean they're not going to look at them. Once again, it's just an area of found revenue for them. They know that taxpayers will tend to be a little more aggressive with these credits, so they will challenge them. So documentation is very important with any type of credits. So if you're taking credits, whether the research and development or anything similar to that, don't be surprised if the IRS sends you a notice. One of the most obvious ones, and I hope everyone's kind of aware of it, is if your income and expenses vary widely from year to year, the IRS will kind of question it. It might be on an informal basis with a generalized letter, or it may be through an examination. And there may be nothing wrong with it. You could have large capital gains in one year. You may have large charitable deductions because your stocks have done well in the market. You make a contribution to a charity. There could be many reasons for these items that are perfectly harmless and really just as a matter of fact, but it will generate a review by the IRS. Next. Also, the IRS will question certain items where you have more than one. So if you have multiple deductions, not just itemized deductions, but IRAs and or credits like foreign tax credits, child care credits, college credits, all of these might be perfectly legitimate once again, but the IRS knows that there's areas for them to look at and it's areas for them to challenge, and sometimes people like to take advantage of that, so that will generate an audit if you have multiple deductions and or credits. Don't want to spend too much time on the earned income tax credit, but what's interesting to note about that is it's a tremendous area of fraud within the IRS that's being perpetrated by many taxpayers out there, where people will set up shops, file false tax returns, and by the time the IRS agencies catch up to it, they close up and move on. So the IRS has a whole task force devoted to this. Unfortunately, not devoted to all the other areas where we love them to be involved in, but this is a tremendous problem. So if you do take the earned income tax credit, or someone in your family does, don't be surprised if you get notices for it. It's just part of their procedures. I also mentioned here certain types of businesses by their nature themselves will generate reviews periodically. I have one client who has a horse farm. He pretty much gets audited every 4 years, even though his farm is very large, has tremendous revenue. It's just the nature of the business. Also, certain types of cash businesses will generate a random audit where the IRS wants to make sure all gross receipts are being reported. And one that's more recent and newer is real estate. With the passage of more recent tax legislation in the last few years and more aggressive depreciation allowances, larger and larger deductions are being front-loaded for purchases and improvements to real estate, generating large losses. So the IRS is looking at that at multiple levels, kind of outside the scope of this call. But if you do have real estate investments and are taking large losses in any period, don't be surprised if the IRS questions it. Currently, right now, I have about 6 of these audits going on within the office, just as a frame of reference. One other thing I just want to mention, I think this is kind of common sense. This is the excessive deductions. The IRS has their own internalized software. Usually, they'll generate automatic notices for this. I mentioned charity before. As the prime example of that, you give a large non-cash contribution, whether it's in securities or some other methodology, the IRS will almost invariably spit out a notice and request more information and, of course, examine the return. Next, please. Yes, I know I mentioned the contributions. We don't need to go through that any further. One thing that's interesting is divorce. This was much more of an issue pre-TCJA in 2018, where they changed the rules on alimony. But there's always historically been a tremendous mismatch on the amount of the reporting of alimony income and deductions between former spouses. Also the filing status and who's claiming dependencies. And the IRS will look at these returns as part of divorce. So it's just something to be mindful of. Cash payments over $10,000, we are seeing this less and less. This is common in the jewelry industry, where people will pay cash for certain items. Certain forms get transmitted to the IRS. Most taxpayers never see them. Usually they're done by banks or other holding companies. This can generate a review, a very random review, I might add, and may have nothing to do with anything, but it is a common issue where we'll see audits generated. Also, and this has also been very commonplace with the CARES Act, where a lot of people were able to take advantage of losses, is when you file an amended return or you file a claim for the refund for the IRS, often the IRS will pull that aside either for their own internal review or to actually generate an audit. In some cases, they could slow up these claims to refunds to over a year. So right now we're going through that process. We have multiple clients, unfortunately, that their returns are being looked at, not so much on a detailed audit level, but the IRS raises questions and slows down this process. Next, please. The incorrect reporting of the health premium credit, what we're finding is happening is certain employees of employers are claiming this credit on their individual return, and thereby actually generating an audit notice for their employers. The penalties for the employees could be quite draconian and tremendous, and it can generate an audit on both ends, both for the employer and the employee. Another area where the IRS will audit is if taxpayers take distributions before they turn the age 59 and a half. Often they will report the income, but they don't realize they have to pay an excise tax. And sometimes they take distributions out of an IRA and then roll it over within 60 days. But sometimes the compliance on this, as a report to the IRS, doesn't always notify the rollover, so the IRS will generate a notice and review the return. Another area is gambling winnings. Obviously, it's something where the IRS wants to see if you have a pattern of winning. Most taxpayers only like to report what's on the 1099-G, but bear mindful, it's pretty rare that people only win on that one shot, on that one lotto machine or that one lottery ticket. Usually the IRS, when they come in to look at that, they're looking for habits, and they're trying to figure out if people are really betting more than they really are, and they should have a net profit at the end of the day. So it's just something that could generate a notice like that. Now, the last two items I do want to talk about, this is just a little more high level. These are kind of recent tax shelter cases that are coming about the IRS, where the IRS gets very excited because they tend to be syndicated by certain individuals who make commissions off of these programs. One of them is the conservation and facade easement. As it maintains, it could be for historical purposes, it could be for keeping things in farming purposes. The valuations in this could be quite subjective, so the IRS will review this once they see them. Another more common practice that was very popular a few years ago, but seems to be taken off a little bit, is where taxpayers have multiple companies. They will create these captive insurance companies offshore, so they get the deduction for making payments. The income is not taxed on the other end, and these assets can go basically outside of the US tax system. So that's all I really have to say at this point. Shivani, I will turn the rest over to you.
Thank you, Frank. In the interest of time, I'm quickly going to launch the third polling question, get any answers as soon as possible so we can move on to the last item on the agenda. Which other practice do I head up at SAX? Cryptocurrency, cannabis, or transaction advisory? I'm just going to give it about 10 seconds more. If you are looking for CPE, please enter in your responses. Closing the poll in 3, 2, 1. And the answer is cryptocurrency. Now, over to you, Helena.
Thank you very much, Shivani. Good afternoon, everybody. I'm going to go over some changes for 2022 and what to look forward to ahead. It is possible that some of these items are still going to change down the road in 22, but that remains to be seen. In general, most of the tax brackets and similar items such as Social Security and stuff were all increased by about 3% this year in 2022, even though obviously expenses and everything else have gone up significantly more. So there's 7 tax brackets, obviously starting with the 10% tax bracket, which is for lower incomes, and it goes up as far as 37% tax bracket for single and head of house people making more than about $540,000, and married filing joint people making more than about $647,000. And this does not include any AMT tax or high income Medicare tax. Next, please. The capital gains tax brackets have also been slightly increased. In the 15% tax bracket starts with $41,675 for unmarried individuals, about $83,000 for married filing jointly, and $55,800 for those filing as head of house. For those in the 20% tax bracket, income would be $459,750 for unmarried individuals, $517,200 for married individuals, and $488,500 for those filing as head of house. The 2022 standard deductions have gone up by the 3% as well. For single, it's $12,950. For married filing jointly, the number has gone up to $25,900. And for those filing as head of house, it's now $19,400. The alternative minimum tax exemptions have also been increased, but for unmarried individuals, the number is now $75,900. And for those married filing jointly, it's $118,100 for 2022. Some of the other changes we're going to see for 2022, one of those is the charitable contribution deductions. As you're aware, under the CARES Act for 2020 and 2021, you were allowed above the line charitable deduction of up to $300 if you were single and $600 for married filing jointly. This has gone away for 2022. So the only way you're going to get charitable contribution deductions in 2022 is by itemizing. So, and the itemized limitations are also going back down to what they were pre-CARES Act. Under the CARES Act, you were allowed to deduct up to 100% of qualified charitable contributions for tax years 2020 and 2021. And those qualified charitable contributions would have been made in the form of cash and made to public charities, which did not include donor advised funds and the private foundations. However, that's gone out of play now for 2022 and forward. Also, some increases to depreciation for 2022. Section 179, which allows companies to deduct the costs of qualified equipment purchases, is going up from $1,050,000 in 2021 to $1,080,000 in 2022, with a max of $2,700,000 for overall investment limits. We also have bonus depreciation on additional first new property acquired and placed in service during both 21 and 22. This is 100% deductible, and under TCJA, this also includes used property which was purchased in 21 or 22. Some reminders on 199A, qualified business income. It's a 20% deduction on qualified business income. It's limited to the greater of either 50% of wages or the sum of 25% of the W-2 wages plus 2.5% of unadjusted basis of the qualified property. The 2022 threshold amounts have been increased. They're $340,100 for married filing jointly, $170,050 for taxable income for single and married filing separately. However, these deductions are completely phased out if income exceeds $440,100 for married filing jointly and $220,050 for those filing single and married filing separately. Excess business losses is also going to see some changes because under the CARES Act, the business loss limitation was suspended for 2018 through 2020. But excess business losses arising after 12/31/20 and before January 1st of 2026 will be limited. For 21, they were limited to $262,000 for unmarried and $524,000 for married. It's being increased slightly for 2022 to $270,000 and $540,000 respectively. Any excess amounts disallowed will be carried forward as a net operating loss. And just note, basis limitation, at-risk limitations, and passive loss rules still apply in addition to these excess business losses. There's also some changes to net operating losses. Under the Tax Cuts and Jobs Act of 2017, the net operating rules were changed. Previously, net operating losses could be carried back 2 years and then carried forward 20 years. However, under TCJA, they changed the limitation of the NOL deduction to only 80% of taxable income. They totally disallowed net operating loss carrybacks, and they removed the 20-year limit on net operating loss carryovers. Again, in 2020, the CARES Act temporarily suspended these NOL limitations for losses occurring in tax years after December 31st, 2017 and before January 1, 2021. So for 21 and forward, net operating losses will once again be limited under these TCJA rules. Also some changes for limitations on the business interest. Under the CARES Act, for taxable years beginning in 2019 and 2020, the business interest expense limitation was the sum of your interest income, 50% of the adjusted taxable income, plus any floor plan financing interest. In addition, taxpayers were able to elect using their 2019 adjusted taxable income to calculate the 2020 limitation due to the fact that many taxpayers' income was higher in 2019 than it was in 2020 due to COVID. However, for 2021 and beyond, the rules are changing. The business interest expense is now limited to the sum of the interest income, only 30% of your adjusted taxable income, plus that floor plan financing interest, if any. And to note, your adjusted taxable income is your taxable income plus interest expense, plus depreciation expense, plus amortization expense. That's the case for 2021. But for 2022 and going forward, you are no longer able to add back depreciation and amortization. Therefore, this is going to reduce your total adjusted taxable income and therefore possibly limit more of your interest expense deduction. I'm going to go over some limits as far as 2021, 2022 tax, FICA, things like that. Social Security wage base is going from $142,800 up to $147,000 for 2022. Social Security is still 6.2% for both employers and employees. The Medicare, the base rate for the employer is 1.45%. However, employees, it's going to be 1.45% for the first $200,000 of wages if you're single, $250,000 if you're married. All remaining wages in excess of those amounts are taxed at the higher rate of 2.35% for Medicare purposes for both 21 and 2022. The IRS also did increase most of the retirement contributions for 22, also by roughly 3%. So the maximum elected deferral for 401k and 403b plans is going up from $19,500 to $20,500 in 2022. The simple IRA plan contributions are going from $13,500 to $14,000 for 2022. IRA contributions are still $6,000 for both years, 2021, 2022. FSA contributions are being increased from $2,750 to $2,850 for 2022. The maximum contribution to defined contribution plans is going up to $61,000 for 2022, and the maximum compensation amounts for SEP plans is going from $290,000 in 21 to $305,000 in 2022. The catch-up contribution limits for the various retirement plans have not changed between 2021 and 2022. They are $6,500 for a 401k plan, $3,000 for a simple plan, and $1,000 for an IRA plan. Some other annual limits for 2021 versus 2022. For estate taxes, the top federal tax rate remains at 40% for both years. The federal exemption is being increased from $11.7 million in 21 to $12.06 million for 2022. Portability is available for both years. There is no NJ exemption because there is no NJ estate tax at this point in time. However, New York does have an exemption, which was just over $5.9 million in 21 and is going up to $6,110,000 for 2022. As far as gift taxes go, the federal exemption limits are the same, $11,007,000 in 21 and $12.06 million in 2022. However, the annual gift tax exemption has gone up from $15,000 in 2021 to $16,000 for 2022. If anybody has any questions, feel free to reach out. Otherwise, it's back to you, Shivani. Thank you.
Thank you, Helena. I'm going to launch the last polling question. Where we do not have a SAX office location, I am going to give it another 10 seconds. Please get your votes in if you're looking for CPEs. We did get a few questions. We will respond to you via email or reach out to you separately with those answers. I'm going to close the polling now. And the answer is Morristown. So if you have any questions, reach out to the panelist. You have our email addresses at the bottom of the screen. And I would like to thank everybody for joining us with SAX Q1 webinar, and we will catch you again next quarter. Thank you.